Well, hey everyone, excited to see as many people as we have on the Zoom chat. We have about 25 here, and we have quite a few more on Facebook as well. So that's really exciting to see the amount of engagement we're getting these last meetings, even though we haven't been able to physically meet. Luke, do you want to say anything about?
Sure. I guess I'll start by just saying I miss the in-person meetings that we used to have and getting the face-to-face interaction. I'm sure most of you probably do as well. One of the things that I enjoy about just networking in general is just the energy that I get from the meetings and just talking shop and talking real estate investing. And it really, helps me kind of want to grind and continue to push myself and learn new things and all that stuff. And lately I've been feeling like sometimes I get into a little negative place with my thoughts, being all by myself and, not interacting with as many people. So I'll be excited to get back to the regular schedule, once we get back into it. But I know, I appreciate everybody just, logging in, staying connected and all the rest of it. And hopefully, you get some value from our talk. I know, Matt, I was at the BiggerPockets conference this past year. I heard you and your wife speak and look up to you guys a lot and all the stuff that you all do. And when Raphael told me he reached out to you and he got you on, agreed to come on, I was like, oh man, this is going to be awesome. So we really appreciate you taking the time out of your day, man, to talk to us. And,
thank you.
We really look up to you. So I think in general, just to tell you a little bit about our group, I'd say in general, what we've tried to do is try to appeal to younger investors, really any investors. We're trying to be kind of an approachable group that's a little bit less formal and a little bit more open about, whatever it is people want to learn about, and trying to do kind of what BiggerPockets does, provide as much value as possible and just build relationships, if you know what I mean. And that's one thing about the conference that I was really impressed by was the relationships and the community that has been built by those guys is amazing. So I know you're part of that, and really appreciate everything that you do. So appreciate you coming on, man. Seriously.
Thank you. I mean, just as you said before, first of all, I'm an extrovert like you are, Luke. That's probably the way I'm reading you. And I am that way too. And so I need people and I feed off of people. So I enjoy any chance I get that I don't get to go someplace live, and I'd rather be on a plane out there to fly to see y'all face to face right now. But I can't do that. So this is as close of an interface as I can get. So, I think extroverts kind of need this, but freaking computer, God bless America, is finally working. So while I'm transitioning here, I just want to let you know that I'm with you, and I wish we were doing this face to face too. Okay, getting let in. And just give me 2 seconds. If you guys want to just talk for just a second while I move my mic over. Thanks for your patience.
Yeah, just to give you some background real quick, for those of you who don't necessarily know who Matt is, he's the author of this book, Raising Private Capital, from BiggerPockets. I'm sure a lot of you do know who he is, and he's done some really cool things over the last few years. I think I saw you on Instagram. They were saying that you're looking at a building right now, a large apartment building in North Carolina. So he's come from the start of working with single family rental homes, and he still does that, but he also does now larger deals. And so he's had a huge transition from single family to multifamily and everything in between. So I think he's gonna be able to provide a lot of cool information for us on a lot of different topics, but also on the topic of raising private capital, which is something that I think if you do want to scale, I think that's something that is definitely something that's extremely important to learn about. So
you can play the lottery too, Yeah. I mean, you could play the lottery or raise money for your deals. I'm just kidding, but it's just raising capital is a way to get into larger deals. It's a way to get yourself into larger real estate. We own about 450 units just in Kentucky, and there's no way I would have got there without private capital, without raising money from investors to work with us on deals. All our stuff's in Lexington, which I love that market. I know it's not too far from you guys. But thank you for those that compliment, Raphael.
So as far as your background, do you want to tell us a little bit about how you got into real estate, what attracted you in the first place, and maybe give us some feedback until this day?
Sure. Yeah. I'll give you my life history up till today, right? No problem. Absolutely. I just like most other people, had kind of what, like when I was a kid, I did did what grownups told me to do with regards to go to school, get a good job, whatever. And I was like, well, I don't know what I want to study in school. And they were like, well, you're good at math and science, so you should become an engineer. So I did. And I went to school for engineering at Virginia Tech and graduated. But the problem was when I started to explore the field of engineering, nobody really showed me that engineering really was something that was going to be more of like a desk job, not a people person job. And I was like, wait a minute, this actually is not what I want to do. So I had to kind of find a way to get into sales because I knew that was a people person job that I would do better at than just being an engineer. So I found my way into a sales position. And just traveled around selling industrial equipment to factories and things like that. That was my position for 7 years. I lived in Kentucky, didn't live in Kentucky, lived in North Carolina, lived in Virginia, lived in Pennsylvania, and met my wife, girlfriend, started dating somebody that became my wife, Liz. And she got me to read Rich Dad Poor Dad. And that was back in 2002, I think. And it just changed my life. It really did. And it just turned my head to the power of entrepreneurship as a path versus like just having a job. And so first rental was a single family home that I lived in. I had enough cash from my day job at the time that I would be able to just buy that single family home on a Fannie Mae 3% down type of thing. And had two of my buddies move in with me. And I'm talking to every single man or woman watching this right now. This is what you should do, period. If you want to get started in investing, you should do a house hack because you just cannot beat the financing. I probably paid 6% back then. You probably would be so lucky as to pay 3% today, locked for 30 years. Why would you not do that on a rental property that you could own and live in for a while and then lease out? So did that. Mortgage payment was $940 a month. My two buddies were each individually paying me $500 a month. So I was living there making $60 a month and living there for free. Incredible arrangement for myself at 26 years old, right? 26, 27 years old. Fast forward to the time that Liz and I got married. We just had bought some rentals, decided to live off of one income. Which is another life lesson that I learned in this whole process, which is something really people should learn, to live a little bit below their means, not at their means, live below, because it'll enable you to make some life decisions that'll springboard you to bigger levels in the future. If you can take some sacrifices now and practice the law of delayed gratification, you can do very well in the future. So we did that and started the DeRosa Group in 2005 when her and I got married. And just really didn't look back from there. Got into residential housing, made plenty of mistakes, did some flips, bought an office building, grew to that, grew into, a few of the small apartments and things like that. Then the market crashed and kind of had to sit on our hands for a little while until things start to get healthy again in 2010. We saw the opportunity and we started raising capital because we weren't raising capital up until then. We were doing it all with our money and immediate family's money. And then we started raising capital in like 2010, 2011, did our first equity deal in 2011, 2 single family homes. Guy put up $50,000. And if you guys read my book, there it is. Read my book. My book will tell you how to find folks in your network that have that kind of capital. So $50,000 was what he put in. Renovated these 2 little townhouses in a downtown urban environment, okay neighborhood, maybe like a C- D+ kind of area, and renovated them, refinanced them. It's a great deal. That was the first private equity deal. That was 2011. And we just slowly built the snowball up. We didn't do that and then try and buy an apartment complex. We did that. And then we bought a few smattering of houses. Then we did a little bit larger deal, Before you know it, we're buying 18-unit apartment buildings. Before you know it, we're buying, after that, we bought a 49-unit apartment building. And it just slowly started to scale and snowball from there to the point where we have a 336 under contract in North Carolina as of a couple weeks ago. So.
That's awesome.
Yeah. Thank you.
Very cool.
Yeah.
I've done a little bit. I saw you post that on Instagram. So that's pretty great.
Thank you. Yeah.
I've done a very little bit of raising private capital myself, and I guess similar to kind of what you started with. Started with a single family house, and I think I've done maybe 4 deals now with 2 different lenders, and trying to figure out how to get to that next step. There's I'd like to take down the bigger deals, but I think I'm still, in that growth phase, trying to figure everything out and all that.
Don't chase the shiny nickels, Luke. I mean, at the end of the day, if you're borrowing money, all the equity is yours. If it's a flip or a burr or whatever, you're making all that upside for yourself, right? And I wish I could say I'm buying this 336 unit complex and I'm getting the lion's share of the profit. No, I got to give a lot of that away. So that's the double-edged sword of equity. The downside of equity is that you've got to sell out ownership to investors to bring them in. And yeah, it's cool for me to say, yeah, I'm buying a 336. And I'm not saying I don't want to be there. I'm super, super grateful to be able to do it. And I can't wait to get that deal to closing and on to fruition and bring it to the next level. But don't forget that, you are going to sell, you're selling out equity. You're selling out ownership that you could have for yourself when you bring in equity investors. Whereas when you bring in lenders, they're just lending you money. And if your deal is producing enough that it can service those loans, whether either when the flip sells or when the rental produces cash flow, all that's gravy. All that gravy is yours.
So is in terms of when you did your first equity deal, you were saying was 50,000, or was that just a lender deal? Was that
it was both. It was funky.
Okay.
I had a self-directed IRA lender put in 50, and then an equity provider that my wife went to college with put in 50. So it was actually, we did both. We did a private loan and private equity blended into one deal.
Okay.
Now the private loan guy got refinanced out because we did a burr deal. We bought the two properties for 25 grand a piece. And then I put another 25 grand a door into them in reno. Right. Okay. Now I acknowledge people are like, oh, you can't do that deal today. You're right. But I also can do other deals today. There's other ways to do it. Right. Yeah. That's like post crash properties were worth 80, 90 grand before the crash. And we bought them for 25 grand. I get it. I'm not saying we got lucky. I'm saying you timed the market, and there's other ways you can play the market right now. But anyway, her friend put in 50 grand and that became part of the LLC. The loan from the lender bought us the properties, and then my equity guy's money came and did all the rehab. Then we refinanced it, took the loan out, and we also took most of the equity out. And so then we took that equity stack out and rolled it into the next deal and did the burr strategy together. Me and this partner did, and leased them for $950 a piece on the market. It's a 2-bedroom, 1 bath. It's this is the East Coast, so the rents are higher, but this is $950 a month we got per house. And then we sold them. We did another investment vehicle path that everybody watching should look into as well. Cash flowed them for like 5 years, made about $300-400 a month total combined between not each of us didn't make that, the company made that, and then we split it. We just paid out once a quarter dividends. Anyway, sold them for a nice profit in 3 or 4 years ago to a buyer that was buying turnkey. He wanted to buy seasoned turnkey assets that had proven rental history, proven tenant history, not like, somebody just went and put lipstick on a pig, threw a tenant in there they found off the street and sold it as a turnkey, which is, you see that happen too. Right. He wanted to see he wanted to see 2 years worth of financial performance, which we could show him because we owned it for 5, right? So we sold it to him as a turnkey to the turnkey buyer. So that's another vehicle. Now, for those of you guys who are looking to make chunks of cash, consider doing turnkey deals, going around Louisville, finding a beat up little rancher or something like that, fixing it up, putting a tenant in there. Yes, you could refinance it and keep it yourself, or you could sell it to someone who wants to buy a turnkey property with a tenant in that's all been renovated and sell it based on ROI. And and with this guy that bought these properties from us, got an 18% ROI because he got bank financing, and we made collectively like 30 grand on the sale. It's win-win. We won, he won, everybody's happy,
So how much equity are you giving up on a deal on a single family deal like that? Is it the same percentage for the larger deals that you're doing, or is it different?
No, it's way better.
It's a lot less.
It's more favorable to do the single family deals. But the numbers are bigger, but the percents are more favorable. Because here's why, right? There's a certain limit to how much your time is worth. So it just doesn't make sense for me to do a 70-30 split plus a preferred return on a 2 single family home deals.
I hear you.
Why are you gonna do that? Well, here's your pref for $30, right? On your money. Like, it doesn't add up, right? So what's the point? So anyway, we did a 50-50 split. We did 50% from my sweat, my equity, and I also stepped in and guaranteed the mortgage because at that level you need to have a sponsor. And he stepped in and sponsored the loan too. Did some legwork also that did not trigger any SECs. We did not sell him a security because he was an active, kind of, sort of, air quote, active investor, not active like I was. You know, he didn't have the kind of sweat on his brow like I did, but still, he did some of the work. Okay. So that's that. Now, I prefer in the beginning 50-50 splits. And then you can kind of, you know, graduate it from there. But as you get into bigger deals, the checks get bigger. So it's okay to take less equity because you're getting a smaller slice, but it's a way, way bigger piece of pie, if that makes sense.
Mm-hmm. Totally. Yeah. And I guess kind of what you were going with earlier, and I think some newer investors probably struggle with the same thing, figuring that like if it's just yours, and that's what I struggle with, is kind of giving up some of that equity piece, if you know what I mean. I'm wanting to keep as much of it as I can and still do the deals. But it's almost like that mindset shift of understanding that you have to, in order to do the bigger numbers, you've got to give up some, and it's going to be more than probably what you want. But at the same time, the numbers are so much bigger that it's worth it. So that's kind of what I'm going through mentally right now. So some of these deals, there's different ways to skin it, right? What I would say is if you're doing a smallish deal, I mean, unfortunately the cat's out, thanks to folks like, you know, not no naming names, but thanks to folks that have really made apartment building buying really cool and really mainstream. Right. It's very hard to tailor your own path on a big apartment building deal. But if you buy a beater 10 unit, okay, you can structure that deal the way you want it to be, right? You can say, okay, Mr. Investor, I'll line up a deal right now. Okay. Investors, maybe you do like a hard money loan or whatever, just to do the purchase price. Then the renovation, because again, this has got to be a beat up. This equation only works if the property's really, really dilapidated and really, really bad shape, right? So let's say Kentucky prices or Louisville, Kentucky prices, you guys buy it. I know your market kind of, sort of, enough to be dangerous. Let's say you buy it for 25 grand a door or 30 grand a door, right? And you put another 10 into it to do kitchens, plumbing, roofs, whatever, you know, 10, 15 grand a door into it. That second bite at the apple and financing comes in as equity. You buy it on hard money, like a hard money lender. So it's expensive, but you get it in and out of it quick. Then the equity piece comes in and you pay them a rate of return on their money, like some sort of a preferred return. And then then you got to refinance the property and hopefully get all their money back out. And then there's no return on their money there except for a small slice of equity, like 20%, 30%. That's it. And you get 70% of the deal. Now they don't have to guarantee the loan. They're really functioning as a joint venture lender. They're lending you the money short term. And if you can service that debt while you have their money, then they should be happy on the loan. And then you give them a little like this big of a slice on the back end because they got their money back and they got a rate of return, you know. Right. That's just a like a little bit of a gravy they're playing for, you know. So if that helps. But no, you can do that. There's no way I'm pulling that off on a 100-unit apartment building. Because the risk is much bigger, or what do you mean by there's no way that you're pulling it off on a 100-unit apartment building?
Because they know the game. The investor, the bigger investors, they read Joe Fairless's book, man. They know how this goes. You know, they know they're supposed to get 70% return plus a 7% pref on their money. You know, it's more common, it's more mainstream on a big apartment building project like that. And there's more savvy investors that want to see a certain split out there. And I'm not saying people that are going to lend you on a 10 unit are not savvy, but you only have to convince 2 or 3 people that, hey, listen, this actually works, you know? And I think that the pendulum has swung too far in the investors' favor, in the passive investors' favor in private equity. It's starting to swing back at post-COVID. It's changing quickly. You know, the return, what I've seen people promising return profiles and things like that was, but it's got to make its way back for things to start making sense. Because what we have to give investors on large apartment complexes deal to satisfy them is, right, you know, it's tough to make it work. It makes a lot of deals not make sense. So we have we're very patient. We find deals that work. We give investors the, you know, what they want to see and all that. But I think it can become very challenging to generate it.
Yeah. You said you were talking about post-COVID. What are you thinking about all this stuff? And I mean, these large apartment complexes, you know, there's 336 units, is that what you said you're looking at? How you think it's going to affect long term here?
It changes the model. It changes what you can do, and what investors are going to agree is feasible, right? Back before COVID, you could do a deal where, like, technically you're presenting investors like, okay, I'm going to make you a 15% IRR, which is a fancy way of saying a 15% return on your money the entire time that I hold it, blended back across the lifetime of that I hold the money for you, right? Internal rate of return. I'm not a big fan of IRR personally. I prefer other metrics, but that's okay. But that's the investors have been trained again by the other voices that are out there. That's the metrics that they should be asking you what your deal is going to do. So that's what they want to ask you. So what's the IRR? Okay. Now before COVID, you could do a deal that produced almost no cash flow, very little cash flow, like single digit mid-range cash flow, through the life of the investment. And then magically some kind of fairy dust got sprinkled on this deal and some magic wand got swung over it and the property's going to sell for double what the syndicator paid for it, right? And that profit when it sells is going to make everybody whole, and the investors are going to get their 15% return or whatever. And people were investing in that kind of stuff, you know, like, oh yeah, you're right. Sure. That makes sense. The market will just keep on going up, you know. You're not seeing that anymore, you know. But if you look at a lot of syndicators offerings, that is what they were doing. They're like, oh yeah, we're going to pay you 6% for the first 5 years. And then we're going to, you know, sell it for the moon. And then you're going to make 15, you know, blended across your life in the investment. You can't do that anymore. You got to do deals that cash flow now. I think that's how COVID's changed a lot of things, in that you got to do deals that cash flow now, and you got to do deals that have some sort of, call it, like, not recession proofness, but, you know, just some sort of contingency plans and some sort of fail safes. So like the deal we're doing in North Carolina, you know what the break even is? 59% occupancy.
Oh, wow. That's awesome.
Yeah.
So that's what you're getting at, the safety net that you have
You
there.
have to. You can't, I'm not going to do a deal. I saw another syndicator roll out a deal again pre-COVID. His break even was 84%. Right? Yeah. Like, man, if the market sneezes, you're screwed.
Yeah.
Like, if just like with what happens, like if the local factory closes or what? I mean, geez, you have a bad month, you're done.
And is that 59% with the current rents, or does that include raising the rents and doing some renovation?
Today's occupancy.
Oh,
that's it today. I'm sorry, today's rents, today's financial performance, and it's 94% occupied today.
Oh wow, yeah. Okay.
So yeah, I mean, it's not with the most upstanding citizens in the world living there, you know. I don't know if everybody's abiding by the law in the place. I don't know. I don't know if they're all. You know, we'll see. So, but yeah, that's we're okay with that. We buy a lot of ugly ducklings and clean them up. That's just what I'm used to doing. I got started in Trenton, New Jersey. What do you want? That's what I know how to do. You know?
What's your favorite market right now to invest in?
I like Kentucky a lot. I'm not just, you know, blowing sunshine. You know, I like Kentucky. I like North Carolina. I used to love Central Pennsylvania, but it got out of it just got out that was a hot market, that was a place to be, and a lot of New York money started pushing down into it. So I'm on the East Coast, so we feel the effects of New York money here. You know, there was a time when Central Jersey was okay to invest, but then just the New York wave, you know, realized New York wasn't a good place to invest anymore, and they just everything in Central Jersey doubled in value. I'm like, okay, well, you can't invest there anymore. Then Philadelphia became the place you could go. No, they found Philadelphia too, and then we ran to Central Pennsylvania, and they eventually caught up with us out there as well. So
do you think in general that's a growing trend as more of these like smaller mid-sized cities start to become noticed by, you know, larger investors, and then there's more money out there? I mean, eventually it's going to be harder to find stuff everywhere, right?
It is now, but the bottom's falling out, man. You know, look what's happening in New York. You know, the reason why they pushed out of New York is because you can't make, you know, money on, like, I mean, no joke, stuff in New York was selling at like a 2.5% capitalization rate, right? So it's like, well, how do you know, I'm going to own it free and clear so I can make 2.5% on my money, you know, right? No, it doesn't make sense. So, but that is changing quickly, and this not potential recession we're either in or going into or whatever. Nobody's been able to give me clear indication on what where we're at here, but the recession that's looming here or in the middle of is going to correct a lot of that. And I think you're going to see retract. You're going to see a lot of big capital pull back,
Right.
And I think it'll make it easier to find deals.
So it's I guess it's an opportunity window essentially. And
but I'm not a doomsday purveyor though. I'm not a market crash guy.
Yeah.
Sorry. It's not, this is not another 2011 or 2008, 9. Sorry. Not going to happen. Not that I can tell.
Crazy back then.
What?
That was pretty crazy back then.
People like, oh, I hope that happens again. No, you don't. I'm telling you what, I invested at that time and we weren't sure like if the world was going to fall apart back then, man. It was scary back then. And one thing people forget, oh, properties were so cheap. Yes. Let me tell you why. Because banks weren't lending, right? You could not get a loan to save your life, back then. Nobody, not small community banks, not credit unions, not the federal government. Nobody was lending back then. That's why stuff was cheap, because you had to buy it cash. That's where I keep pointing the wrong freaking way in the mirror here. That's where this became a factor. Now I don't think it's going to happen again like that, but it's already become harder to get money from a bank anyway. I get told no this afternoon on a deal. It's okay. I get told no too.
Pick up the phone again, right? And call somebody else. I get told no a lot.
Yeah, cool. Hey man, y'all got a bunch of questions here in the Zoom chat.
Planning on asking.
And Raphael, you're letting Luke Bogart me here, man.
No, but Luke has a great question. That's completely fine. And
I'm loving the chat, man. This is good. Go ahead.
So I had a quick question, then we'll go to those questions.
Whatever you want.
As far
all
as
yours, man.
When you first get started in real estate, really it's about getting educated. And I think that's a big reason why a lot of people are here. They're just trying to learn more about real estate. Some of them have already done some deals and they're starting to get a little bit of wind in their sails. But at a certain point when you're talking about scaling, like you said, it's related to private capital. So, I mean, I read your book and I kind of got an idea of how you structure raising private capital.
Yeah.
And I think the way you described it is number one's a deal provider, right? You as the deal provider, if you don't have money, you can be the deal provider as long as you can find a good deal. I mean, there are people out there that are willing to do it. And then you said something about a cash provider. Do you kind of want to elaborate a little bit on those concepts?
Yeah. Well, there's two different things that you need to make a deal. Like once you got a deal, you need two things. You need money and you need time, right? And it's got to be it could be all yours, both those two things, or you could divide those two things up and have it partly somebody else's money and partly your money and partly your time and partly somebody else's time. But you got to carve that equation up somehow. The way that I described it in Raising Private Capital is that, those that find the opportunity and are willing to put their time in exchange for some equity ownership are the deal provider. And they're also in some ways the deal operator, the deal, the whip cracker, whatever you want to call it, right? Then the cash provider is somebody who's really looking more for a passive return on their money, more hands off, more like, hey, this is awesome, Mr. Deal Provider. I love this opportunity, but I'm going to just write the check for whatever this is. And I want a return on my capital. And the cash provider has to acknowledge that they're going to be taking a little bit of a haircut on what they could make if they own that property on their own. And that's an education we have to do as deal providers to say, yes, this deal may produce a 15% cash on cash return, but I can't give all that to you. I got to keep some of that for myself for assembling this thing and for putting it together for you and everything like that. So, so that's what the cash provider is. They're leveraging other people's time in exchange for a good return. And people devalue in some ways the deal provider. And I would never, if you're trying to raise money, I would never work with anyone that doesn't see the value in what you're creating as the deal provider, because what you're giving is time, which is the one limited resource in the world, by the way. There's enough of everything else. There's enough deals, there's enough money, there's enough, resources and people and contacts. The one thing we only got but so much of is time. And I'm willing to put mine into that deal for you, Mr. Deal Provider. We let the cash provider be up on a pedestal a little more than we should. It's evil, we're helping them, cash providers. So they're helping us, we're helping them. It is a symbiotic 50-50 relationship in some ways.
And you did state, I think in the first deal, the people that you know are generally speaking going to be some of the first people that start investing in your deal because they trust you, right? You've kind
Yes.
of that.
Yeah, well, that's what Raising Private Capital talks about that. Because those of you guys that are watching, they're just getting started in real estate. They're like, well, nobody's going to go give me any money. Well, maybe, but you go to people that like and trust you because you're you. Go get educated. Learn enough about this business so you don't go wrap this thing around a tree and go lose somebody's money, right? And get yourself a good network that can help you. But after you've done all that, you can go to people that like you because you're you, not people because that are going to give you money because you're this awesome real estate investor. You guys all are, you can be. But I would start with people that like it, that have that established relationship with you outside of real estate investing.
That's awesome. Yeah, that's great advice, because that's something I'm sure I've never raised money with the deals, but for example, right now I'm in the process of purchasing a property, and my parents are the ones who are not funding the deal. I'm funding the deal, but they're the ones that are going to be on with me on the loan in order to ensure the loan, because I'm in real estate, so my income, I haven't been in real estate for more than 2 years, so they're pretty much coming in the deal and just being like the silent partners with this.
That's how I got started, man.
Yeah.
That's how I got started. Do whatever it takes,
For sure.
When I first quit my job, my wife was one with your earned income. So my wife had to come into all my closings and sign, it's like she had to be my, she had to be my co-signer for everything, because I didn't have the real estate track record at the time to sign off.
That's awesome.
Yeah, I think a lot of people are like that in the beginning.
Mm-hmm.
But yeah, I guess what we'll do is we'll go ahead and go to the questions now at this point. So if you want, I'll go ahead and read them off for you.
Sure.
So Jim Young, hey Jim, he asks, Matt, it sounds like you're advocating doing an equity deal as a specialized line of business instead of dabbling. Am I hearing you correctly? So
yeah. So yes, Jim. But what I would add on to that further is that I tend to work. This is when I was doing small deals, and I could kind of offer a few different flavors of ice cream. We've grown a bit, and it's hard for me to do that now. But in some ways, I miss the days where, when an investor would show up and say, hey, I want to lend to you out of my self-directed IRA, and I've got 150 grand, and I'm 58 years old, and I need this money back in a year or two. I'm like, great. You should not take that money and put it into an equity deal. You should take that and put it into a private loan. Happen to have this fix and flip or this BRRRR deal over here. Perfect opportunity for you. You're not going to pay any tax on your self-directed IRA. Let me put you into that. And then the second the phone rings later on that afternoon for somebody else is, hey, Matt, I just refinanced my house. I got 100 grand in equity sitting here. Not sure what to do with it. I don't need it. And it's just sitting here, and I want to make a good return. I'm a high income earner. I could use some tax write-offs. What should I do? Then take them and put them in an equity deal, because they get the tax benefits. They get this, they get that. The money's just sitting there. It doesn't cost them very much at all. So the best way to do this as you guys grow is to tailor arrangements to meet your investors' goals. Too often we don't ask investors, where do you want to go? What are your goals? And let me find an opportunity that meets my goals and yours, and you can come up with an arrangement that meets that. What I used to do a lot of was customizing opportunities for the investor. You can't do that once you grow so big, you can't do that as much anymore. It's kind of just like vanilla. This is what I got. You want to invest with me. I got this apartment building right here, and you make it interesting enough and wide enough that most investors can benefit from it. But to answer your question, Jim, I don't think that I think the door of scaling mass in smaller real estate deals is open. I don't see anybody doing that. Everybody wants to be the next whatever, the next big apartment building guru or whatever, and they think that they need to scale to that to be successful. But I don't think you do. I think you can actually scale out and buy 105 units for a 500 unit portfolio versus going and buying 5 100-unit apartment buildings, because the competition is steep on that side. So to answer your question, I think that you should try that way. Go the smaller route and develop a boutique equity kind of way to arrange it. Not something I did, but I think the door is open for somebody to jump into that seat and offer smaller one-off real estate deals. It's my 2 cents.
That's awesome. All right, so Matt, Hey, Matt. He says, should the deal come first or should the capital come first?
Capital comes first.
Capital comes first. You line up
The
the
reason
capital prior.
what's that?
You line up the capital prior to actually.
Yeah, you have to, because just deals don't close on your timeline. They close on in a timeline you agree upon with the seller, right? And it's not like, okay, Mr. Seller, give me a couple months to go and raise this money and go call my Aunt Sally or whatever. And this is my first time talking to her about real estate investing, by the way. So it might take me a couple meetings with her to convince her that she should do this. You got to line up Aunt Sally and the guy you went to high school with and your next door neighbor and, all these different people that have capital, line them up, right? Then go out and find a deal. And you can use a hypothetical deal, whatever, but deals aren't going to wait for you to find the money. Deals operate at a very quick timeline. So I would highly recommend you guys, find the money first, at least some money, not all the money, maybe find some money, your foundation of money, and then launch off of that. So.
Awesome. And then as far as the deals are concerned, so let's say you do have the money lined up. How do you find a deal? And you talk about this a little bit in your book, but I thought you wanted to elaborate a little bit on it.
Sure. I mean, how do you find the money? Sure. Well,
no, okay. The deal. Once you have the money lined up. So.
Oh, well, you gotta, I guess I don't know if I get in the book or not. I don't know. The book's more about how to find the money, but I mean, what I talk about on my insider, it's like point, there you go. There it is. I'm trying to look over my shoulder and point. What I talk about a lot in my insiders community, and on my YouTube page too, is you guys got to pick a market, right? So you guys are in Louisville. So if Louisville's the market, great. If Lexington's the market, great. If Cincinnati's the market, whatever it is, pick the market you want to be in and then drill into that market. Do not, I'm shopping Louisville today. I'm shopping Lexington tomorrow. I'm shopping Cincinnati next week. And then the week after that, I'm going to go to Tennessee. Not a city in Tennessee, the whole state I'm going to shop, you'll end up banging your head up against the wall. So the way you find great deals, Raphael, is by drilling into a specific market, meeting the brokers, get into the neighborhoods and zooming in. The deal we just put under contract in Winston-Salem, we've been shopping Winston-Salem for a year. And then that deal came up, made a lot of offers, met with a lot of brokers, bought a lot of coffee for people, and that, just trying to figure out that marketplace. So that's how I think the way you find a deal is by shaking that market as hard as you can and getting into that market, meeting with brokers, meeting with wholesalers, meeting with people that know opportunities. And the secret dark horse that nobody talks about to turn over leads for deals is property managers. Right? You guys should all be talking. Number one, you need them, and number two, they maybe know tired owners. They're like, I'm just sick of it. I'm just sick of they just don't want to do it anymore. Or they're just aging out, whatever. And the PM may try and buy it themselves, but they can't buy everything. And if they have a broker's license, which they should anyway, they can make a commission selling it to you. So talk to property managers too.
Yeah, I know. I've actually heard that from several people recently. Talk to property managers looking for deals. I know, I don't think Brett Grigsby's on here, but a friend of ours, he works for a large company in town, manager in town. I think they manage about 3,500 or 4,000 units, and they're sometimes selling.
What's the name of the company?
It's Denton Floyd.
Oh yeah, we use them.
Yeah. So
but they manage 3 buildings for us.
Do they? Okay.
Great. Awesome company.
Yeah. He buys stuff that they have. He works for them, so he'll hear about stuff first, and then,
yeah, that's why they don't call me, huh?
Well, I know they're putting together a deal on an 18 unit right now. So
okay. Yeah. I guess my ringer was turned off, I guess, when they called.
I'll tell him that's that was
yeah. Tell me they must have lost my phone number. So yeah, no, I'm joking. Yes, congratulations. That's awesome.
But so I know another question that was asked on here also is talking about underwriting the deals. We talked a little bit about that earlier, but is there like a spreadsheet or something that you have, or your break-even requirement or something like that that you look at when you're looking at the deal to see if it's something that you want to pursue?
Yeah, well, we use for bigger deals. You talking about for big stuff or small stuff?
Bigger stuff.
Okay. For bigger stuff,
people kind of have a better handle on how to evaluate, if you know what I mean.
So I'm lucky enough that I've got a team. I surround myself by smart people. I'm like the stupidest person on my team. and that they're all smaller, that they're all way smarter than me. I got an underwriter that does all my underwriting work, and he's awesome. I've got an asset manager, I've got a acquisition specialist, and then I've got an operations person that does a lot of the back end ops, right? And then because of that, I forget the last time I personally underwrote a deal. And that's because you don't want to buy a deal that I underwrote myself, because I'm not that good of an underwriter. You want to buy something that somebody else did. So I would always find someone to help me review my numbers, take a look, make sure everything looked kosher and all that. So we use, I'll say software that we use, but I'm not an underwriter, but I know that we all use, and I know how to do it. I'd rather just look at the global overview on the numbers and make sure that everything adds up. The software we use is called the Syndicated Deal Analyzer, SDA, Michael Blanc. Now, we took it and put it on steroids. We took it and customized it and made it our own. Because what the great thing about the SDA is it's just an Excel spreadsheet. It's just a jacked up Excel spreadsheet. So you can take it and play with it, So we took it and made it more customized.
Gotcha. So how do you go about finding these underwriters? Or is that just being in business for a while, or?
Well, I guess you gotta wait till the world opens back up. But you could find them. You could find them on like all kinds of different circles. You can ask around. We were approached. Like I went on Michael Blanc's podcast, and my partner did too. Like a couple months after I did, and our underwriter called him. So you could put a note out. I mean, the BiggerPockets on the marketplace allows you to put a job posting out. Right? I'm hiring, but it doesn't have to be you're hiring a job. It could be like, I'm looking for a partner, there's different personality traits that are required for real estate investing. And there's no one person that makes the best real estate investor. There's a person that contributes to one of the 4 areas of real estate investing, and you can be good at that one area and maybe good enough at the other ones to kind of fake it till you make it kind of thing, but you're not going to be good at all 4 of them.
That's really good advice. I feel like that's kind of where I am. I feel like I'm good at like certain aspects of it, but I'm having trouble like wanting to either partner or join up with somebody else. And I'll do all my stuff by myself, me and my wife, and but that's really good advice to hear.
Yeah. So. Yeah, it's okay. You just gotta put it out there and find people that are way different than you are.
Right. Cool. Let's see here. Oh, your YouTube channel. You mentioned your YouTube channel earlier. What's the name of it? Is it just your first and last name? Or?
No, it's everyone. I'll put it out here. It's just www.youtube.com/DeRosa Group.
DeRosa Group. Okay.
No.
Somebody else was asking what happens when we text 66866 or text DeRosa to 66866.
Your phone spontaneously combusts. No, your phone will explode. No, it'll tell your phone turns into a bar of gold. No, none of that happens.
It probably does turn into a bar of gold.
You guys get that's just like a free, like a thank you for watching, and that's literally just a here you go, guys. A bunch of free articles I wrote. 2 of you got the PowerPoint presentation. I don't even know if they're okay that I did this, but I'm just doing it. The PowerPoint presentation I did at BiggerPockets, the conference that had like 1,000 people there that you were there at.
Yeah.
That PowerPoint is in there. My wife's PowerPoint is in there that she gave at the BiggerPockets conference. Remember I talked about the 4 factors, the 4 people that are right. There's a presentation on those 4 factors in there.
All right.
Too. And then there's a bunch of stuff on COVID, including Denton Floyd's procedures on COVID, right? Okay. They okayed me putting that in there. So the way Denton Floyd's handling COVID is in that thing. So you get an email back with a ton of stuff. You also get the opportunity to join our insiders community. It's just one of those things that's a private Facebook group that costs a whopping $24 a month. And you get to pick my brain on a weekly basis. You get to follow us around on deals like that 336 unit. We underwrote that deal live on Insiders. We shot a ton of live. Justin Fraser, my asset manager, is in North Carolina at one of our assets in Fayetteville right now. And he did a half-an-hour live session. Just let people pick his brain, ask him questions, show me an apartment. So he did, and show me this, show me that. So it's just hands-on, just seeing hands-on action. It's called DeRosa Insiders, and you can get the beginning intro to it by going to 66866. Just texting DeRosa to 66866.
I'm gonna do it. Sounds good to me.
Come out. Yeah, get out there, man. Yeah.
That's cool. Let's see what else we got here. Go ahead.
That question. Oh, yeah. So should your underwriters or other team members have equity in your deals, or do you just pay them a salary? Are they kind of like 1099 or what are they?
Yeah, there's underwriting services you can find. I don't know what they're called, but there's outsourced underwriters and stuff like that. I don't believe in that. I believe my underwriter is a partner because I view the underwriter as creating the business plan for the property, right? And so that I bring the underwriter in as the underwriters on my deals always get equity because they earn it. No other way to say it. Like they work hard for that. And so this isn't just, run the numbers and cut me a check kind of thing. This is run the numbers, get a check, do the valuations, do the validations and everything like that. There's a lot to underwriting and also confirming the business plan and helping carry a deal to closing in the underwriter role. So we always give equity for that. And they get a chunk of the acquisition fee too.
Sounds good.
Mm-hmm.
Man, it's cool stuff. It's fun. Yeah. It's getting me energized, guys. Talking about it.
Yeah, somebody wrote, Danny wrote to me privately, but I want to answer it publicly. He said, I'm considering forming a private equity fund. Have you considered that? I believe private equity funds and blended funds are going to be the future post-COVID of real estate. People are not going to want to cross their fingers and hope that one deal you got going on is going to make it work and is going to succeed. I think that the way that we are going to move forward in the future as real estate syndicators is offering diversity of real estate investments. And that when you invest, you get a little slice of all these different things and it all rolls up into a blended return for you. So yes, Danny, we are absolutely working on a private equity fund and I got one going right now. I'm met with my partner to form a lot of we worked on legal today for my private equity fund. So yes, we're working on it now.
That's cool.
So it's just a quick question on that. I guess the question I would have surrounding if the private equity fund setup is the fees, I believe, are going to be one of your biggest hurdles. Unless it's a capital call, it's type fund where the sponsors don't actually deposit their capital in the fund's account, basically.
Mm-hmm.
And so because if you're paying a preferred rate of return of 8 or 9% per year, and you're not buying anything, like you have a difficult time.
Michael,
it's meeting your return goals.
Cool. It's Michael, right? Yeah, there you go. Yeah, I had to put the mouse over your name there, right? Okay, over your picture. Okay, so you got to have a short-term parking lot for the money if you want to do it like that,
Mm-hmm.
right?
Yeah.
And so we do our short-term parking lot is like short-term assets like distressed mortgage notes, private loans, things like that, right? And so you got to park the money in a thing that can get placed like that, and then you build up a pool until you wait for the bigger thing, the big apartment building or the 10-unit deal, the 10-unit deal that somebody else is going to buy here or whatever, and then when that deal comes up, then you fund that next deal, so you got to park the money somewhere. I don't believe in capital. I don't think capital call funds are a good idea because investors, I think it's going to be hard to convince an investor to let their 50 grand, 100 grand, 200 grand sit on the shelf for you until you come up with something. And if you're not paying them anything on the money,
Mm-hmm.
There's better opportunities. They could go put it somewhere else while they wait for you.
Okay.
So I wouldn't count that money as in the bag. Yeah,
that makes sense because are you talking about a very different fund structure than what I was considering? Because it's the private equity real estate that I come out of, like the capital commitments are 10, 15, 20 million dollars.
Mm-hmm.
So it's a completely,
I'm not doing it like that. I'm not trying to make rich people richer. I'm trying to take the middle of the road people that have their IRA on Wall Street, right?
Yep.
on the roulette wheel over there and show them how they can take that and put it into real estate.
Mm-hmm.
You know?
Okay. Yeah.
I'm not looking for $5 million checks.
Okay.
I'll take a $100,000 check all day long over a $5 million check. People like, what? You're crazy. You know, the $5 million check comes with a lot of strings, comes with a lot of lawyers too. You know, and it comes with a lot of, they're going to want to govern how they're in your deal and that. So we're not looking to do a traditional Wall Street looking private equity fund. I'm looking to do a more manageable, everyman's private equity fund kind of thing.
Okay. Yeah. It makes sense.
Mm-hmm.
What we'll do is we have one more question we'll ask, and then we'll probably wrap up because we're getting pretty close on that hour. So I think Matt asked the question is, what does your equity split look like between you and your underwriter and other partners? Do you generally take the lion's share, or is it kind of split evenly? Or
I wish I could say that. Wouldn't that be great? Like 90% to Matt Faircloth and the other peons take their other. No, not like that. We're pretty even as a team. I mean, I take an override for being the lead of the team, for being like, you know, call it the CEO or whatever. But then the capital raiser and the asset manager, and then the acquisition specialist and the, you know, those team members make around the same in equity and in splits. Just keeps it simpler that way. And so people tend to break it up in 20 to 30% tranches. Not of the deal, of the GP. So the GP is somewhere between 20 and 40%. I do not believe you guys should do 10% GP deals where it's a 90% to investors, 10% to the GP. There's just not enough skin in the game for, if your deal has to be like that to get returns to investors, you got the wrong deal. But we do 70-30 splits, and then we take that 30% and carve it up around what I said, around 20% per seat on the bus, and then another 20% to the team lead.
Cool. All right. So like I said, we're run up on the hour, so we'll go ahead and wrap this up. But really, thanks again, Matt, for coming by and sharing insights. And I know
let's do this face to face, man. Soon. Kentucky's the first state that we do business in where the courts are actually open. I got a lot of 7-day letters out today. So so we want to do more in Kentucky, and we're enjoying your state. And if people want to get a hold of me, they can just go to derosagroup.com. And I hope you guys decide to join us at Insiders by just texting DeRosa to 66866, and you guys can pick my brain more often.
For sure. And when we do have in-person events, we'll definitely reach out to you and let you know. And hopefully you can swing by one of our events. We used to have a lot of people show up, so I think it'd be cool to.
We were out there about once every 2 or 3 months in Kentucky before pre-COVID. Yeah. We went to Lexington about once every 2 to 3 months. If we're under contract on something, we're out there every couple of weeks. But we're not under contract right now. Right now we're just stabilizing everything we got. It's just kind of like weather in the storm. So, yeah.
Well, we'd love to have you sometime, Matt. So
sure.
If everything starts back up, we'll definitely be in touch.
Love to.
So, awesome, man. Thanks so much for your time.
Raphael, thank you. Luke, thank you. Michael, thank you, guys. Nice meeting you. Take care.
Yeah, it was good seeing you. See you guys.
See y'all later. Thanks.